2.10 is a question that's going to look a little bit like the question on the SAC, and it's important to realise what we've been given as information. So we've been given a balance sheet at the 31st of July, and that's going to represent the start of the current period. So in this case, we've been given that balance sheet, and then we've been given a whole bunch of transactions, and what we're actually asked to do is to then produce a new balance sheet at the end of August. So we learned that to record transactions, there's not going to be any marks for that. We'll learn how to record them properly on the next SAC. But for now, what we're going to use is this transaction tool. So you can have this in the SAC, but it's not an official document that'll be in the exam or any other SACs. And all we'll do is make sure that each transaction does go into the accounting equation and balance. So the first thing we've got is payments to creditors for $400 to City Stationers and $500 to Link Engineering. So we've got less cash, and then we'll decrease our creditors, each of them separately as so. We've then got 2 new trailers bought on credit. It's important to remember that this business sells trailers, so that actually becomes stock. So we've got more inventory. We've been charged GST, which reduces our GST liability. And in this case, were they bought on cash or credit? They were actually bought on credit. So our creditor Link Engineering will go up to 640. Debtors paid the business $500, so I have received more cash, so cash goes up, but debtors will subsequently decrease. A new fax machine was purchased for $900 cash plus GST of $90, so cash will decrease $990. 900 will be the office equipment that we bought. We'll file fax machine under office equipment, and GST will decrease as well. Then got a sale. We're given total sales of $4,000 for the month plus GST, and total cost of sales $1,800. But we're going to actually break it into 2 amounts. $3,300 was received in cash, and $1,100 will be received next month, and the implication being that was made on credit. So first of all, let's deal with the cash. We've received $3,300. What's it for? Well, $300 is GST that doesn't belong to the firm, so it'll become an obligation to pay to the government, so the liabilities will increase, and that leaves $3,000 of revenue. Similarly, we'll have $1,100 charged on credit, so instead of cash going up, it'll be debtors that will increase. GST will go up, and so will capital, representing the revenue. Lastly, we've got cost of sales of $1,800. That's what we had to sacrifice to make these sales, so stock will decrease, and stock is an expense when it's sold called cost of sales, and that decreases owner's equity. Then got expenses for the month for wages $2,000 with no GST, advertising $500 with GST, and rent $4,600 with GST as well. So just adding all that up, the total expenses is $7,100. That's the total of the wages, the advertising, and the rent without the GST. So expenses decrease owner's equity, so that's why capital will go down. We're going to look for the GST, so we've got GST now on advertising and rent. That's a total of $510, so that'll decrease our liability to the government. And therefore, we must have, it says these were paid, so cash must have gone down $7,610, which is the total of the GST and the expenses. The owner withdrew $800 for personal use, so cash will go down, and so will owner's equity. And lastly, $200 was paid off the firm's loan to Easy Finance. We've got less money, but we'll also lower the loan amount that we owe to Easy Finance. So that's how we use the transaction tool, but there's no marks for that. So what we subsequently need to do is to take the old balance sheet on the left and then turn it into a new balance sheet on the right. So let's start with cash at bank. A month ago, cash at bank was $1,100, and there's our assets column from the transaction tool. So what we'll do is update the original opening balance of $1,100 with the following numbers. Cash went down $900, up $500, down $990, up $3,300, down $76.10, down $800, down $200, and we'll add that up in our calculator, and we'll end up with a cash balance of negative $5,600. So if the cash balance is negative, rather than listing it as a current asset, we're actually going to put that as a current liability called bank overdraft. The next thing we've got is debtors. Debtors at the start of the month owed us $800, but we can see the 2 items there. Debtors decreased $500, but also went up $1,100, so that'll be a closing balance of $1,400. We had stock at the start of the month of 22,500, so we bought more, so that went up 2,400, but we sold 1,800. That'll leave a closing balance of 23,100. And lastly, we've got the office equipment. So you can see the advantage of this transaction tool is that as we're going, we're ticking off each item that we entered, and that sort of lets us figure out which items we have and haven't updated in the new balance sheet. So looking at office equipment, it was 4,000. We're going to increase at $900 and get a final balance like so. Let's look at the liabilities. We started off with a GST liability of 1,000, but we've got quite a few transactions. It went down 240, down 90, up 300, up 100, and down 510. Net result is we're going to owe the government $560. We've got Link Engineering was owed $2,000, and you can see some was paid back, but then we also bought more from them, so that'll leave a final balance of 4,140. The next liability in the original balance sheet was City Stationers. They were a creditor. We owed them $400 and we paid them $400. So do we need to list them in the new balance sheet with a balance of zero? And the answer is no. We don't list zero balances in the balance sheet. Lastly, we had a loan to Easy Finance. We owed them $8,000 and we paid them $200, so we'll decrease that to $7,800. We're going to list that as a non-current liability. The question hasn't stated whether it is or it isn't, so we're just going to make an assumption. That'll leave capital. So capital was an opening balance of $17,000, and we can see all the transactions in blue during the month were transactions that affected capital. So if we recalculate using our calculators, we'll get a new balance of capital of $11,300. So what we've got now is just a regular balance sheet, which we've used or updated with our transaction tool. So all we've got to do is total each section. We've got current assets, total current non-current assets, and total assets, current liabilities, non-current liabilities, and capital. And if we add up the three numbers in the right-hand column on the equity side of the balance sheet, we'll get a total equities of $29,400. And remember, that's a checking mechanism to see whether our balance sheet does in fact balance.